So now I think this much is pretty clear, like what, who issues the currency note, the medium of exchange, money, right? I think you will remember all these points. Take a note of everything and try to think, beyond the books. I think that is one of the most important thing. Okay, so coming to deposit with bank. So the first point is people deposit money which they do not need at a point of time by opening a bank account in their name. Second, bank accept the deposit and also pay an amount of interest on the deposit. What do we understand? Okay, what happened is, like, for example, I'm having 1 lakh rupees with me. My salary is 1 lakh rupees. Just imagine, although I don't have it, but still just imagine I have a salary of 1 lakh rupees. So it's very obvious we will not be spending all the money at one go, right? We will not be spending the money at one go. So what we will be doing is, we will be taking out some part of the money for a day-to-day use, and leftover money, fine, leftover money we will be depositing in the bank. Because in bank there are plenty of things which we look or think for. Like, first, most important, our money is safe. At home, maybe something can happen. It can get tear, it can get wet, thief can come and rob your money, plenty of things. It is not safe to keep so much of money at your home. I think it's unsafe for everyone, right? But basically what we do is, the leftover money, we just give it, or you can say we keep it in the bank. And what in return of that, we get the rate of interest. I think you must have heard of, because we are giving our money to the bank. And where that money is being used by the bank is not our concern. In return, we will be getting a rate of interest. You can say a sum on a sum of amount, amount on our deposit money. For example, if I deposit 100 rupees and a rate of interest is 10% per annum, so I will be getting 110 rupees. That is 10 rupees as an interest, right? So this is my profit. I am just depositing my money, and in return I am getting some interest, right? No? So this is something very important. You can make profit, guys. So, like, the second point is check. Okay, check. Check is a paper instructing the bank to pay a specific amount from the person account to the person's account in whose name the check has been issued. Okay, so like you can see on your screen, there is a picture, and here you can also see that. One second. Okay, I'm unable to draw it, guys. One second, please. Yeah, like you can see this place, this pay. I guess it's not working. No issues. It got hanged. Okay, like you can see this part. Fine. This part is pay, right? So here what we usually do is we put the name, or we write the name of a person to whom we want to pay the amount. So with the help of this, we usually write our name in the pay column, and then rupees, the sum of amount we want to give to the another person. That amount in word we write in this column, and in numbers we write here, right? And downwards we sign. That only makes the check legal, right? Otherwise it is, you can say, invalid. Simple. Otherwise it is invalid, right? So check is something, a feature you get from a bank. It's a feature you get from a bank when you want to transfer money, or you can say pay money to another person. And that can happen in any bank. For example, my account is in State Bank of India, your account is in HDFC Bank, so I can deposit check in your bank. Fine, but I should write the name of yours if I'm paying money to you. So that is the importance of check. Fine. So I think this feature can be used to settle down the payment without the use of cash. You will not be needing hard cash for this. You can just use this, you can say, a piece of paper that we call it as check to transfer the money from one person account to the second person. Okay, now the next point is loan activities of bank. So what does that mean? Bank keeps only a small proportion of their deposit with themselves as a provision to pay the depositors who might come to withdraw from the bank on any given days. And rest, bank use a major portion of the deposit to extend loan, that is credit, and bank mediate between people who have surplus fund and those who are in the need of those funds. Okay, so now we will understand what does that mean, that loan activities of bank. So you know guys, what bank usually do, there are so many accounts in a bank. So many people deposit huge sum of money in the bank. So what bank do is, and you might be knowing, no? We just read bank also pay rate of interest to us, to the depositors. So from where that interest, from where they gain that interest. So what bank usually do is, bank keep some amount of money with themselves, which bank want to give it to the, say withdrawers, right? The one who is coming in the bank to withdraw the money. So some amount is kept by the bank to give it to the people who want to withdraw the money. And rest of the money, bank give it on loan, or you can use a term credit. So bank give it on credit to, you can say, to financial institutions, to people who are in need of that money, and in return they charge a huge sum of interest. You understood? In return they charge a huge sum of interest. So the difference between the interest which is earned by the bank by lending that money to the needy person, subtract minus the interest the bank is paying to us, the depositors. So the difference is the profit of the bank. Simple. So, and bank also act as the, you can say, mediator between the depositors and the borrowers. Bank is here, we are here, we are depositing the money in the bank, and this borrower is coming to the bank to borrow the money. So bank is the mediator. He is taking our money and lending it to the borrower, and he is taking interest from the borrower, keeping his share and giving rest of the interest to the depositor. Simple. So this is how bank work. I have also explained you how the bank work. Fine. So in this slide it is the same thing. Bank charges a higher rate of interest on the loan what they offer on deposit. The difference between what is charged from the borrowers and what is paid to the depositor is their main source of income. So I guess guys, this we have already done, right? So moving forward, we have credit. Fine. We have credit, that is loan. Basically, it refers to an agreement in which the lender supplies the borrower with money, good or services in return for the promise of future payment. So credit facility or loan facility is something when I'm in you can say I'm in very need of money, right? But right now I don't have it. So what I will do is I will borrow that money. I will borrow that money as a loan, or you can say as a credit, from various sources. It can be bank, it can be cooperatives, it can be, my friends, family, relatives, money lenders, there are various forms of, you can say, the one who lend the money, various forms of lenders that we will be studying in our next slide. But here what person do is, person borrow that money from, you can say, lenders, and promise them to return back the money with interest. Fine. So with interest, whenever you are taking loan, whenever you are taking amount on credit, you always have to pay an interest for the borrowed amount, right? Again, the same example. For example, you borrowed 100 rupees and the rate of interest charged by the lender is 10%. So how much you will be returning back? 110 rupees. So 10 rupees will be your interest, okay? And you promise that person to pay in the future. And it is not like that. You get the money just, without any security. No. You also have to give, you can say, you have to sign an agreement to get the money, because I think in today's scenario, in today's world, nobody trusts anybody. Fine? When it comes to money. So that also we will be studying. So moving forward, like you can see, in some situation, credit plays an important and a vital role. But in some situation, it makes the situation of the borrower worse than before. That we call it as debt trap. If I'm in need and someone is helping me, fine, someone is giving me loan, I think it is very good for me because that person helped me in my, you can say, needy times, right? But sometimes this loan becomes a headache. Trust me, loan became a headache for the borrowers. So here we use a business term, or you can say economic term, that is debt trap.